Afternoon, class. Today I'm going to go over Chapter 10, some key points. I'm going to discuss the partnership termination and liquidation and describe in detail the accounting for a partner's capital account following liquidation. So steps involved in partnership termination and liquidation. So liquidation of a partnership generally involves these three steps. Non-cash partnership assets are sold for cash, and gains and losses on the sales are allocated to the capital account of individual partners on the basis of the profit and loss ratios. Partnership liabilities and expenses incurred during the liquidation are paid out of the partnership's available cash, and any partnership cash remaining after paying liabilities and liquidation expenses is distributed to the individual partners on the basis of their respective capital balances. So sooner or later, all partnerships end. The three liquidation steps pretty much take care of the non-cash assets are sold for cash and then allocated. Liquidation costs are paid from the partners' available cash, and then the remaining cash is allocated to the partners. The accountant summarizes and keeps track of the process in a statement of the partnership liquidation. Liquidation of a partnership becomes complicated if one or more of the partners have a negative or deficit capital balance, or liquidation takes place over an extended period of time. So accountants can facilitate distribution of cash in installments by calculating a safe payments. The accountant might prepare a cash pre-distribution plan. So learning objective 1, determine amounts to be paid to partners in a liquidation. So final capital balances. Procedures involving in terminating and liquidating a partnership are basically mechanical. Assets are converted into cash to pay business obligations and liquidation expenses. Remaining assets are distributed to partners based on their final capital balances, and partnership books are closed. If each partner has a capital balance large enough to absorb all liquidation losses, accountants should experience little difficulty in recording this series of transactions. So an example, here we have a balance sheet. Morgan and Houseman allocate all profits and losses on a 60-40 basis. The partnership has $75,000 of non-cash assets to be liquidated as seen on the 2017 balance sheet. So here we have cash, accounts receivable, inventory, land, total assets, and then your total liabilities, which consist of liabilities and then Morgan and Houseman's capital. Our $75,000 in non-cash assets are represented by the $12,000 of accounts receivable, inventory of $22,000, and $41,000 of land and building and equipment. So learning objective 10-2, prepare journal entries to record the transactions incurred in the liquidation of a partnership. So the events. Assume the liquidation of Morgan and Houseman proceeds in an orderly fashion through the following events. So June 1st, the inventory is sold at an auction for $15,000. July 15th, a total of accounts receivable, which is $9,000, is collected, and the remainder is written off as bad debt. Fixed assets are sold for a total of $29,000. All partnership liabilities are paid. $3,000 in liquidation expenses is paid to cover costs such as accounting, legal fees, and commissions incurred disposing of partnership property. All remaining cash is distributed to the owners based on their final capital account balances. So following those events, these are the journal entries that represent that. So the first one here, we have to record sale of partnership inventory at a $7,000 loss. So when they sold the inventory, they took a loss. The inventory was on the books for $22,000. They received $15,000 in cash. The difference of $7,000 is allocated to the two owners based on their percentages, 60-40, and that's where you have the $4,200 and the $2,800 entry. The second one is to record collection of accounts receivable with write-off of remaining $3,000 in accounts as bad debt, and again, they received $9,000. The accounts receivable was on the books for $12,000, so the offsetting difference again is to the capital account of the two owners for $1,800 and $1,200. So record the sale of fixed assets and allocation of $12,000, a $12,000 loss. They received $29,000. Land, building, and equipment was recorded at $41,000, the carrying cost. And so the difference is offset by the two owners, Morgan and Houseman, for $7,200 and $4,800 respectively. Then we have an entry to record a payment made to settle the liabilities of the partnership. Again, that was directly to liabilities and cash for $32,000. And then the final entry is to record payment of liquidation expenses with the amounts recorded as a direct deduction to the partner's capital accounts, where you have a debit of $1,800 and a debit of $1,200 to record a $3,000 cash paid out in liquidation expenses. So the partnership that closed quickly, they have a lot of losses, as you can see in this example. So changes in partners' capital balances. So gains and losses are recorded directly to the partner's capital account. Determination of net income for the period would be of little information of value. A primary concern of partners involved in liquidation is keeping track of the continuing changes in each partner's capital balance. After partnership assets are liquidated and obligations are paid, the remaining $63,000 cash is distributed to Morgan and Houseman on the basis of their capital balances, which is 60-40. A schedule is prepared to determine the partner's ending capital account balances and the appropriate distribution of the final cash balance. So here we have the schedule. And so they're taking consideration of beginning balances of beginning capital balances for both partners, Morgan and Houseman. You have the inventory that was sold, allocated, the loss allocated, the collected accounts receivable, sold fixed assets, what was paid in liabilities, paid in liquidation expenses, and then the final totals. And then here we have a journal entry recording the distribution of cash to close out the partnership's financial records. And so the final entry is a debit to Morgan's capital and Houseman's capital for $35,000 and $28,000, and a credit to cash for $63,000. So once remaining cash is distributed, the financial books are closed. Statement of liquidation. Accountants should produce frequent reports summarizing transactions as they occur. The statement of liquidation is prepared at periodic intervals to disclose the transaction to date, assets still being held by the partnership, liabilities remaining to be paid, current cash, and capital balances. Partnership liquidation usually requires numerous transactions over months and perhaps even years. Frequent statements of liquidation to both creditors and partners keep these stakeholders apprised of the results. So basically they're saying that this process isn't as concise as the example would show. Sometimes it's dragged out over a very long period of time, and accountants need to keep track of every transaction so everyone is aware of the balances at all times. Learning objective 10-3. Determine the distribution of available cash when one or more partners has a deficit capital balance or becomes personally insolvent. So a statement of partnership liquidation final balances. So in the previous example, the liquidation process ended with both partners having positive capital balances. And here, this is an illustration of the previous example where Morgan and Houseman both ended up with positive balances. And this was the activity and how we broke it up between cash, non-cash, and liabilities. And remember, the distribution of the remaining balance was $63,000. So each partner was able to share in the remaining $63,000 cash. So a deficit capital balance. At the end of liquidation, one or more partners could have a negative capital account, or the partnership could be unable to generate even enough cash to satisfy all of its creditors' claims. Deficits are most likely to occur when the partnership is already insolvent at the start of the liquidation, or the disposal of non-cash assets results in material losses. Under these circumstances, accounting procedures applied depend on legal regulations and individual actions of the partners. So some partnership liquidations resulted in negative capital accounts. So as an example, assume the partnership of Holland, Dozer, and Ross was terminated at the beginning of the current year. Business activities ceased and all non-cash assets were subsequently converted into cash. During the liquidation process, the partnership incurred a number of large losses that have been allocated to the partner's capital accounts on a 442 basis, respectively. A portion of the resulting cash is then used to pay all partnership liabilities and liquidation expenses. So assume that the following four account balances remain open. So here they've already run through all of the transactions of selling assets and everything. They're just giving you the remaining capital accounts and the cash that's on hand. So Holland has a negative capital balance of $6,000, as you see here. Assigned share of partnership losses has exceeded Holland's capital balance at the date of the partnership termination. So once they allocated losses, his capital account was so low that it went negative. And so the issue here arises that Dozer and Ross are due $15,000 and $11,000, but they theoretically can't take their money because there isn't $26,000 available. So the Uniform Partnership Act, which we spoke about before, stipulates that the partner shall contribute to the partnership an amount equal to any excess charges over the credits in the partner's account. So therefore, Holland legally is required to contribute an additional $6,000 to eliminate the deficit. The cash balance is raised to $26,000, which allows a complete distribution to be made to Dozer for $15,000 and Ross $11,000 based on their capital account balances. So here they're saying that Holland is required to pay the difference in his capital account to bring it to zero. And so once he does that, they'll have enough cash to actually pay out Dozer and Ross exactly what they're due. And this is a journal entry example of that. So journal entry for final payment closes out partnership records. So cash, a debit for $6,000, and you credit Holland's capital for $6,000. To record a contribution made by Holland to extinguish negative capital balances, and then you'll debit Dozer for $15,000 and Ross for $11,000, and credit cash for $26,000. And it's to record distribution of remaining cash to partners in accordance with their ending capital balances. So you also have alternative scenarios where Holland could resist attempts to force him to contribute the $6,000 to cover the deficit of his capital account because the business is in the process of being terminated. So he may say, because we're closing anyway, I'm just not going to pay. And so the remaining partners may have to resort to some formal litigation to get Holland to contribute. So in that case, until the legal action is concluded, the partnership records remain open but inactive. So distributions of safe payments. So while awaiting final resolution, no compelling reason exists for the partners to continue holding the $20,000. Because remember, they do have $20,000, they just don't have the $26,000. So the cash will be eventually paid to Dozer and Ross regardless of any action that Holland takes. An immediate transfer should be made to the two partners to allow them to use their money. So because Dozer has a $15,000 capital account balance and Ross reports $11,000, a complete distribution is not possible. So a method must be devised, therefore, to allow for a fair allocation of the available $20,000. So the initial distribution is based on the assumption that the $6,000 capital deficit will be a total loss to the partnership. So Holland may be completely insolvent, so no other additional payment will ever be forthcoming. With this conservative presumption, calculate the lowest possible amount or safe balance that Dozer and Ross must retain in their capital accounts to be able to absorb all future losses. So determine the amount of safe payment that can be made to Dozer and Ross without running the risk that future losses will cause either of the partners to have a deficit capital balance. So here, should Holland's $6,000 deficit prove to be uncollectible, the loss will be written off against the capital account of Dozer and Ross. So allocation of potential $6,000 loss. So they're going to have to take the $6,000 and allocate a portion of it to the other two partners based on their percentages. So in here, they're showing you the calculation, and Dozer will end up with a $4,000 and Ross with $2,000 against their capital accounts to make up the negative $6,000 from Holland. And so the allocation of the loss is based on the relative profit and loss ratio specified in the articles of the partnership. So Dozer and Ross are credited with 40% and 20% of the partnership income, respectively. And so the 40-20 ratio equates to a 2-to-1 relationship or a 2-3 or 1-to-3 between the two. Dozer could be forced to absorb an additional $4,000 loss, and Ross's capital account could decrease by $2,000. These balances must remain in the respective capital accounts until the issue is resolved. A safe payment of $11,000 is made to Dozer that reduces his capital account from $15,000 to the minimum of $4,000 level, and a $9,000 payment to Ross decreases his capital balance to the $2,000 limit. These safe payments can be distributed to the partners without creating new deficits. So basically, Dozer was supposed to receive $15,000, but he's gonna take a $4,000 loss out of the $6,000, which is gonna allot him $11,000, and Ross is gonna take a $2,000 loss, which is gonna allot him $9,000 out of his $11,000, and so they're leaving essentially $6,000 to cover the $6,000 loss from Holland, but they're gonna distribute the $20,000 that's available. Other potential outcomes: the partnership could recover a portion of the $6,000 from Holland, but the remainder could be uncollectible. Holland could become bankrupt, or the other partners could simply give up trying to collect from him. The partners could also negotiate a settlement to avoid protracted legal actions. And in an active partnership, insolvency can occur if losses, partner drawings, or litigation depletes the operation's working capital. So learning objective 10-4, prepare a proposed schedule of liquidation from a safe capital balances to determine an equitable preliminary distribution of available partnership assets. So preliminary distributions. So partnerships often have sufficient cash balances at the date of termination that some cash can be paid out to individual partners before non-cash assets are sold. The accountant can determine a preliminary distribution of the partnership assets at the beginning of the liquidation process. A preliminary distribution ensures that a partnership maintains enough capital to absorb all future losses. Any capital in excess of the maximum requirement is a safe balance, an amount that can be immediately conveyed to the partner. So basically what they're saying here is that an accountant can take consideration if the business is liquidating and say they have $100,000 worth of cash on hand, and when they go through and calculate with good judgment that they're only going to owe maybe $40,000, he can take some of that money and just allocate it right off the top to the partners, so they can go on and do whatever they're trying to do, and it doesn't have to be tied up. Safe payments. To determine a safe payment to be made to a partner at any time, the accountant assumes all subsequent events will result in maximum losses. So he's to determine that whatever the max amount you could lose in each one of these categories, that's the presumed amount. No cash were received in liquidating remaining non-cash assets. Each partner is personally insolvent. Any positive capital balance that remains after the inclusion of all potential losses can be paid to the partner without delay. Although the assumption that no further funds will be generated could be unrealistic, it does ensure that negative capital balances cannot arise as a result of premature payments being made to any of the partners. So liquidating partnership balance sheet. So to demonstrate the computation of a safe capital distribution, assume that a liquidating partnership reports the following balance sheet. So here we have cash, $60,000, non-cash assets of $140,000, total assets of $200,000, liabilities of $40,000, and then another $160,000 worth of capital transactions and a loan. And so your total liabilities and capital are $200,000. So assume partners estimate that $6,000 will be the maximum expenses incurred in carrying out the liquidation. The partnership needs $46,000 to meet all obligations. So that's $40,000 to satisfy the partnership liabilities here, and another $6,000 for the liquidation expenses. So they're determining they're going to need $46,000 to fully liquidate. The partnership can transfer $14,000 to the partners immediately without fear of injuring any participants in the liquidation. The balance sheet shows that Mason has conveyed $20,000 to the business, an amount that was considered a loan rather than additional capital. Is the $27,000 to be viewed as a liability to the partnership or as a part of the partner's capital balance? The loan is merged with the partner's capital account balance at the beginning of liquidation. So because the partnership holds $60,000 in cash, it can transfer the extra $14,000 to the partners immediately. once you subtract what they determined, the 46,000 they're determining they're going to have to pay to liquidate. So a proposed schedule of liquidation. To structure an equitable distribution of the 14,000, a proposed schedule of liquidation is developed based on the assumption that all future events will result in total losses. And so this schedule is prepared by the accountants. Proposed schedule of liquidation, initial safe capital balances, and here you have the beginning balances, maximum loss on non-cash assets, maximum liquidation expenses, payments of liabilities, which already knows 40,000. Then you have your potential balances. Then you assume Lee to be insolvent, and potential balances assume Mason to be insolvent, and then your safe balances, and that allows them to allocate the 14,000. So that's the end of chapter 10. Please reread over your notes and over the chapter. Thank you.